I am about to tell you something that will make most American investors uncomfortable. Something that goes against everything they have been taught. Something that challenges the conventional wisdom that has dominated investment thinking for the past 15 years. American stocks are not the best opportunity in the world right now. In fact, they might be among the worst. I know how that sounds. America has the largest economy in the world. American companies dominate technology, healthcare, finance, and consumer products. American markets are the deepest and most liquid on earth. The S&P 500 has crushed international stocks for over a decade. Why would anyone look elsewhere? That is exactly the kind of thinking that precedes major shifts in market leadership. That is exactly the consensus view that creates opportunity for contrarian investors. And that is exactly why I am finding better values outside the United States than inside it. Let me take you back to the year 2000. The American stock market was on top of the world. The S&P 500 had returned over 20% annually for the previous 5 years. Technology stocks had made ordinary people millionaires. America was the undisputed center of the financial universe. Nobody wanted to own international stocks. Why would you, when American stocks were making everyone rich? Then came the crash. The dot-com bubble burst. American stocks fell for 3 consecutive years. The S&P 500 lost almost 50% of its value. All those paper millionaires became paper paupers. And do you know what happened to international stocks during the following decade? They crushed American stocks. From 2000 to 2010, emerging markets returned over 150%, while the S&P 500 returned essentially zero. International developed markets outperformed America by a wide margin. The consensus that American stocks were the only place to invest turned out to be exactly wrong. I am seeing the same setup today, the same extreme outperformance of American stocks, the same consensus that America is the only place to invest, the same dismissal of international opportunities, and I am positioning my portfolio accordingly. This is not about being anti-American or pessimistic about the United States. I live here. I invest here. I believe America will remain a great country with great companies. But great countries with great companies can still have overvalued stock markets. And right now, the American stock market is one of the most expensive in the world by almost every measure. Let me show you the numbers, because the numbers are stark. The S&P 500 currently trades at roughly 22 times earnings. The cyclically adjusted price-to-earnings ratio, which smooths out short-term fluctuations by averaging earnings over 10 years, is above 30. That puts American valuations in the top 5% of historical readings. The only times valuations have been higher were 1929 and 1999. Neither of those ended well. Now compare that to international markets. Developed international stocks trade at roughly 14 times earnings. Emerging market stocks trade at roughly 12 times earnings. Some individual country markets trade at single-digit multiples. The valuation gap between American stocks and international stocks is near all-time highs. What does this mean for future returns? History is very clear on this point. Starting valuations are the single best predictor of long-term returns. When you buy stocks at high valuations, you get low returns over the following decade. When you buy stocks at low valuations, you get high returns over the following decade. Based on current valuations, American stocks are likely to return somewhere between 2 and 5% annually over the next decade. International stocks, starting from much lower valuations, are likely to return somewhere between 7 and 10% annually. That is a massive difference. Compounded over 10 years, it could mean the difference between doubling your money and barely keeping pace with inflation. Now, I know what the skeptics will say. They will say that American stocks deserve higher valuations because American companies are better. They have higher profit margins. They have stronger competitive positions. They have more innovation. The premium is justified. There is some truth to this argument. American companies, particularly the large technology companies, have built extraordinary businesses with remarkable profitability. But the question is not whether these are great companies. The question is whether the current prices adequately compensate you for the risks. And I do not think they do. The valuations being placed on American companies assume that current profit margins will persist indefinitely. They assume that competitive advantages will never erode. They assume that growth will continue uninterrupted. They assume perfection. But perfection rarely happens in business. Profit margins tend to revert to mean as competition intensifies and new entrants emerge. Competitive advantages erode as technology changes and consumer preferences shift. Growth slows as companies get larger and markets mature. The assumptions baked into American stock prices are heroic, and heroic assumptions usually disappoint. Let me give you a specific example. The largest American companies by market capitalization are the technology giants. Apple, Microsoft, Alphabet, Amazon, Nvidia. These companies trade at valuations that assume decades of continued dominance. But technology is one of the most dynamic and unpredictable industries in existence. The dominant companies of one decade are often the also-rans of the next. Think about which technology companies dominated 20 years ago. Microsoft was still there, but Nokia was the mobile phone king. BlackBerry was the smartphone leader. Yahoo was the search giant. AOL was how people accessed the internet. Intel was the undisputed chip leader. Most of these companies are shadows of their former selves today. Will Apple still dominate smartphones in 20 years? Will Google still dominate search? Will Nvidia still dominate artificial intelligence chips? Maybe. But paying current valuations, you are betting that they will. You are betting on perfection. And betting on perfection is a losing strategy over the long run. International stocks do not require you to bet on perfection. The valuations are low enough that companies can stumble, can face headwinds, can disappoint in various ways, and you can still earn reasonable returns. There is a margin of safety built into the prices. That margin of safety is almost entirely absent from American stocks. Let me talk about some specific international opportunities that I find attractive. Not individual stock recommendations, but regions and themes where I see genuine value. Japan is fascinating to me right now. Japanese stocks have been out of favor for over 30 years. The bubble that burst in 1990 left deep scars on investor psychology. An entire generation of investors learned to avoid Japan, and that avoidance has created opportunity. Japanese companies today trade at significant discounts to their American counterparts. Many trade below book value, meaning you can buy the assets of the company for less than they would cost to replace. Corporate governance is improving as activist investors push for better capital allocation. Share buybacks are increasing. Dividends are rising. The Japanese yen has weakened, making Japanese exporters more competitive globally. The narrative around Japan is changing, but the prices have not fully caught up. This is exactly the kind of setup I look for. A market that has been ignored for so long that prices reflect excessive pessimism. A catalyst for change that is just beginning to be recognized. The potential for both multiple expansion and fundamental improvement. Europe is another region I find interesting. European stocks have underperformed American stocks for years. The narrative is that Europe is sclerotic, overregulated, lacking in innovation. And there is some truth to this narrative. European companies generally are not as dynamic as American companies. European economies generally do not grow as fast. But the prices reflect this pessimism, and then some. European stocks trade at roughly half the valuation of American stocks. You are getting a 50% discount for whatever disadvantages European companies might have. Is Europe really that much worse than America? I do not think so. The discount is excessive, and Europe has some genuine strengths that get overlooked. European companies dominate luxury goods, an industry with incredible pricing power and brand loyalty. European companies are leaders in industrial automation, renewable energy, and healthcare. European banks, while troubled for years, are finally returning capital to shareholders after a decade of restructuring. Emerging markets are perhaps the most interesting opportunity of all. Emerging market stocks have been terrible investments for over a decade. China's regulatory crackdowns, currency crises in various countries, political instability in others. The list of problems is long, and investors have fled. But emerging markets represent the majority of global economic growth. Their populations are young and growing. Their middle classes are expanding. Their consumption is increasing. The long-term fundamentals favor emerging markets over developed markets simply because of demographics and development trajectories. And the prices are absurdly cheap. Emerging market stocks trade at about half the valuation of American stocks. Some individual markets trade at single-digit price-to-earnings ratios. You are being paid to take on the additional risk and volatility that comes with emerging market investing. Now, let me address the obvious counter-argument. American stocks have outperformed international stocks for 15 years. What makes me think this will change? The answer is valuation. Valuations matter. They do not matter over months or even years, but they matter enormously over decades. And the valuation gap between American and international stocks is now so extreme that the probabilities strongly favor international outperformance. Think about it mathematically. If American stocks trade at 22 times earnings and international stocks trade at 12 times earnings, American stocks are almost twice as expensive. For American stocks to continue outperforming, either American earnings have to grow much faster than international earnings, or the valuation gap has to widen even further. Can American earnings grow much faster? Unlikely. American companies are already more profitable than international companies. The gap is unlikely to widen significantly. And earnings growth ultimately depends on economic growth. And the American economy is not going to grow much faster than the rest of the world over the next decade. Can the valuation gap widen further? Theoretically, yes, but practically there are limits. At some point, even the most enthusiastic American investor looks at the numbers and says, "This is too expensive." At some point, even the most pessimistic international investor looks at the numbers and says, "This is too cheap." Valuations do not go to infinity. The most likely outcome is that the valuation gap narrows. American valuations contract while international valuations expand. This by itself would generate significant outperformance for international stocks, even if the fundamental performance of the companies were identical. Let me share a framework I use for thinking about international investing. I divide the opportunity into three categories. The first category is developed international markets with stable institutions and transparent companies. Think Japan, the United Kingdom, Germany, France, Australia, Canada. These markets have sophisticated financial systems, strong rule of law, and companies that report financials according to standards comparable to the United States. The risks are primarily valuation risk and currency risk. Valuation risk cuts in favor of these markets right now. They are cheaper than America. Currency risk is harder to predict, but currencies tend to revert to purchasing power parity over the long run, and several major currencies are currently undervalued relative to the dollar. So, currency could be a tailwind rather than a headwind. The second category is emerging markets, with growing economies and improving institutions. Think South Korea, Taiwan, India, Brazil, Mexico. These markets have higher volatility and more political risk than developed markets, but they also have higher growth potential. They are where the marginal global consumer lives. The valuations in these markets are even cheaper than developed international markets. You are being compensated for the additional risk with additional value. I think this is an attractive trade-off, particularly for investors with long time horizons who can tolerate short-term volatility. The third category is frontier and deep value markets that are essentially uninvestable for most people. Think Vietnam, Nigeria, Pakistan. These markets have real growth potential but also significant governance and liquidity issues. They are not appropriate for most portfolios, but they represent the extreme end of the valuation opportunity. For most investors, the opportunity is in the first two categories. Developed international markets for stability and reasonable value, emerging markets for higher potential returns with higher volatility. A mix of both provides diversification and exposure to the international value opportunity. Let me talk about the specific risks of international investing, because I do not want to pretend this is a free lunch. There are real challenges and real risks that need to be acknowledged. Currency risk is the most obvious. When you invest internationally, you are exposed to fluctuations in exchange rates. If the dollar strengthens against other currencies, your international investments lose value even if the underlying stocks go up. This can be painful in the short term. However, currency risk cuts both ways. The dollar has been strong for years, which has hurt international returns for American investors. But currencies are cyclical. The dollar will not stay strong forever. When it weakens, international investments will benefit. Currency could be a tailwind over the next decade rather than a headwind. Political risk is more significant in some markets than others. Emerging markets in particular can experience sudden changes in government policy, nationalization of industries, capital controls, and other events that destroy shareholder value. This risk is real, and needs to be taken seriously. The way to manage political risk is through diversification. Do not put all your international allocation in one country. Spread it across multiple regions and multiple markets. If something goes wrong in one country, it will not destroy your entire portfolio. Information risk is another consideration. It is harder to research international companies than American companies. Financial statements may use different accounting standards. Language barriers may make it difficult to read company reports. Local market dynamics may be unfamiliar. This information disadvantage is real, but it can be mitigated by investing through funds rather than individual stocks. A good international fund manager has the resources and expertise to navigate these challenges. For most investors, that is a better approach than trying to pick individual international stocks. Liquidity risk varies significantly across international markets. Major markets like Japan and the United Kingdom are highly liquid. Smaller emerging markets may have limited trading volume and wide bid-ask spreads. This can make it difficult to buy or sell positions at fair prices. Again, diversification helps. Stick to the more liquid markets unless you have specific expertise in smaller markets. Do not invest more in any single illiquid market than you would be comfortable losing entirely. Despite these risks, I believe international stocks are a better risk-adjusted opportunity than American stocks right now. The valuation discount more than compensates for the additional risks. You are being paid to take on challenges that, while real, are manageable with proper diversification and fund selection. Let me address one more objection. Some investors argue that they already get international exposure through American multinationals. Companies like Apple and Coca-Cola and Procter & Gamble generate significant revenue outside the United States. Why buy international stocks when American stocks already give you global exposure? This argument misses the point. Yes, American multinationals generate international revenue, but the stocks are still priced in the American market at American valuations. You are still paying 22 times earnings for that international revenue. When you buy international stocks directly, you pay 12 times earnings for that same revenue. The multiple matters. Also, there is a difference between a company that sells products internationally and a company that is based internationally. Local companies often have competitive advantages in their home markets that multinationals cannot replicate. They understand local consumer preferences. They have relationships with local suppliers and distributors. They navigate local regulations more effectively. By investing directly in international companies, you gain exposure to these local champions that American multinationals cannot provide. Now, let me tell you how I think about portfolio allocation between American and international stocks. This is not investment advice for your specific situation, but a framework for thinking about the opportunity. The traditional recommendation has been to allocate based on global market capitalization. American stocks represent roughly 60% of global market cap, so you would put 60% of your equity portfolio in America and 40% international. This is a reasonable starting point. But I think current valuations justify deviating from this benchmark. When American stocks are expensive and international stocks are cheap, you should overweight international. When the situation reverses, you should overweight American. This is not market timing, it is valuation-based allocation. Based on current valuations, I would argue for something closer to 50-50 or even an overweight to international stocks. The valuation gap is extreme enough that tilting away from America makes mathematical sense. You are giving up some exposure to great American companies, but you are gaining exposure to cheaper valuations that are more likely to generate strong returns. This overweight should be revisited regularly. If American stocks become cheap and international stocks become expensive, you should reverse the allocation. The goal is not to permanently favor one region over another, but to tilt toward wherever the better values are at any given time. Let me also discuss the role of emerging markets specifically. Emerging markets are more volatile than developed markets, both domestic and international. They should probably be a smaller allocation than developed international markets for most investors, but they should not be zero. Something like 10 to 20% of your equity portfolio in emerging markets is reasonable for most long-term investors. This gives you exposure to the higher growth potential while limiting your downside if something goes wrong in a specific country or region. The cheap valuations in emerging markets compensate for the additional volatility over long time horizons. I want to close by addressing the psychological challenges of international investing, because the hardest part of this trade is not the analysis. The hardest part is having the conviction to hold when the trade is going against you. International stocks have underperformed American stocks for 15 years. If you buy international stocks today, they might underperform for another year or 2 or 3. The valuation gap might widen before it narrows. You might watch American stocks continue to rise while your international holdings lag. This will test your conviction. It will make you question your analysis. It will make you want to give up and buy American stocks like everyone else. And if you give up, if you abandon the position right before it starts working, you will have experienced all the pain with none of the gain. I have experienced this many times in my career. My bets against housing took years to pay off. During those years, I was losing money while everyone else was making money. My investors were angry. Some of them withdrew their capital right before the trade worked. They could not handle the discomfort of being different from the consensus. International investing today requires the same kind of conviction. You have to be willing to look wrong for a while. You have to be willing to underperform your neighbor who is fully invested in American tech stocks. You have to be willing to trust your analysis even when the market is telling you that you are wrong. The market is not always right. In fact, the market is often wrong at extremes. When everyone agrees that American stocks are the only place to invest, that consensus itself is a warning sign. The best opportunities are found where others are not looking. And right now, nobody is looking at international stocks. I am looking. I am finding values that do not exist in America. I am building positions that I expect to outperform over the next decade. I am willing to endure short-term underperformance for long-term outperformance, and I am confident that the math is on my side. American exceptionalism is a powerful narrative, but narratives change. The narrative of Japanese dominance changed in 1990. The narrative of American technology supremacy changed in 2000. The narrative of emerging market growth changed in 2011. Narratives that seem permanent rarely are. The narrative of American stock market dominance will change too. I do not know exactly when, but I know that current valuations are unsustainable. I know that the gap between American and international stocks is extreme, and I know that extreme gaps tend to narrow over time. When that narrowing happens, investors who own international stocks will profit. Investors who are fully invested in America will underperform. The opportunity is clear. The question is whether you have the conviction to act on it. I prefer international stocks over American stocks in 2026. Not because I am pessimistic about America, because I am realistic about valuations, because I follow the math wherever it leads, and because the math clearly favors looking beyond American borders for opportunity. Let me go deeper on something I touched on earlier, because I think it is critical to understanding this opportunity. The concept of reversion to the mean is one of the most powerful forces in financial markets, and it applies powerfully to the relative performance of American versus international stocks. Reversion to the mean simply means that things that have deviated far from their historical average tend to move back toward that average over time. Extremely high valuations tend to come down. Extremely low valuations tend to go up. Extended periods of outperformance tend to be followed by periods of underperformance. This is not a guarantee, but it is a strong historical tendency. American stocks have outperformed international stocks by an extreme amount over the past 15 years. This is a deviation from the long-term historical average. Over the very long term, going back decades, American stocks and international stocks have produced similar returns. The current period of American dominance is the exception, not the rule. Reversion to the mean suggests that this exception will eventually end. International stocks will have their period of outperformance. American stocks will have their period of underperformance. The timing is uncertain, but the direction is not. Extreme deviations do not persist forever. I have built my entire career on reversion to the mean. When I bet against housing in 2005, 2006, and 2007, I was betting that housing prices, which had deviated far above their historical relationship to rents and incomes, would revert to the mean. They did, spectacularly. When I bought distressed assets during the financial crisis, I was betting that prices that had crashed far below intrinsic value would revert to the mean. They did, generating enormous returns. Today, I am betting that the extreme outperformance of American stocks over international stocks will revert to the mean. This is the same type of bet. A bet on historical patterns reasserting themselves, a bet on extremes normalizing, a bet on math winning out over narrative. Let me also discuss the dollar, because currency is a crucial component of international investing for American investors. The dollar has been strong for years. This strength has been a headwind for international stocks. When the dollar rises, the value of international stocks in dollar terms falls, even if the stocks are going up in local currency. But currency strength, like everything else in markets, is cyclical. The dollar does not go up forever, and there are reasons to think the dollar might weaken over the coming years. The United States has massive budget deficits and a growing national debt. At some point, foreign investors may become less willing to finance these deficits, which would put downward pressure on the dollar. The Federal Reserve may need to cut interest rates if the economy weakens, which would reduce the yield advantage that attracts capital to dollar assets. Other countries may reduce their reliance on the dollar for trade and reserves, reducing structural demand for the currency. None of these factors guarantee a weaker dollar. Currency forecasting is notoriously difficult, but the balance of probabilities suggests that the dollar is more likely to weaken from current levels than to strengthen further. And if the dollar weakens, that provides a tailwind for international stocks that amplifies their return advantage. Some investors hedge their currency exposure when investing internationally. They use derivatives or currency-hedged funds to eliminate the impact of exchange rate movements. This can make sense for short-term tactical positions where you want to isolate the equity return from the currency return. But for long-term strategic positions, I generally do not recommend hedging. Hedging costs money, and those costs compound over time. More importantly, currency diversification is valuable in itself. Owning assets in multiple currencies protects you if something goes wrong with the dollar. If the United States experiences a currency crisis or high inflation, your international holdings provide a hedge. I think of my international allocation as both an equity investment and a currency diversification strategy. I am getting exposure to cheaper stocks and exposure to non-dollar assets. Both of these are valuable in the current environment. Let me talk more specifically about individual regions and why I find them attractive. Japan deserves special attention because it represents perhaps the most interesting turnaround story in global markets. For 3 decades, Japan was synonymous with stagnation. The bubble that burst in 1990 cast a long shadow. Japanese stocks went nowhere for 30 years while American stocks compounded relentlessly. But something has changed in Japan. Corporate governance reforms have taken hold. Companies are being pressured to improve returns on equity, to return excess capital to shareholders, to focus on profitability rather than empire building. Activist investors, both domestic and foreign, are finding receptive audiences for their demands. The results are showing up in the numbers. Japanese companies are buying back stock at record levels. Dividends are increasing. Balance sheets are being optimized. Return on equity, while still below American levels, is improving steadily. And the valuations still do not reflect this improvement. You can buy Japanese companies at book value or below. You can buy companies with net cash positions exceeding their market capitalizations. You can buy dividend yields that far exceed what is available in America. The market still prices Japan as if it were stuck in the lost decades, even as the fundamentals improve. I think Japan offers the potential for both multiple expansion and fundamental improvement. The market could re-rate as investors recognize the governance improvements, and earnings could increase as companies become more shareholder-focused. This combination could produce returns far exceeding what American stocks are likely to deliver. South Korea and Taiwan are interesting for different reasons. These markets are dominated by technology companies, particularly semiconductor manufacturers. They trade at significant discounts to comparable American technology companies despite having equally strong competitive positions. Taiwan Semiconductor is arguably the most important company in the world. Without its advanced chip manufacturing, the entire technology industry would grind to a halt. Yet it trades at a fraction of the valuation of American technology companies with weaker competitive positions. The discount reflects geopolitical risk, particularly the threat of Chinese aggression against Taiwan. This risk is real and should not be dismissed, but I think the discount is excessive. The market is pricing in a worst-case scenario that, while possible, is far from certain. If the geopolitical situation remains stable, these stocks could re-rate significantly higher. South Korea offers similar opportunities. Samsung is a global leader in memory chips, displays, and consumer electronics, yet it trades at a discount to American companies with narrower competitive advantages. Hyundai and Kia are gaining market share in the global auto industry, particularly in electric vehicles, yet they trade at valuations that assume they are going out of business. The Korean discount reflects both geopolitical concerns and historical corporate governance issues, but governance is improving in Korea just as it is in Japan. The discount appears excessive, given the fundamental quality of these businesses. India deserves mention as perhaps the best long-term growth story in the world. The demographics are extraordinary. Over 1 billion people, with a median age well below that of China or the developed world. A growing middle class with increasing purchasing power. A services economy that can grow even as manufacturing moves elsewhere. Indian stocks are not as cheap as other emerging markets. The market has recognized India's potential and bid up valuations accordingly. But I would argue that paying a premium for India's growth is justified. The growth is real and sustainable in a way that growth in other emerging markets may not be. India also has less geopolitical risk than markets like China or Taiwan. Relations with the West are generally good. There is no territorial dispute that could trigger conflict. Political risk exists, but is manageable. For investors who want emerging market exposure with less tail risk, India is attractive. Brazil is a more speculative opportunity, but potentially very rewarding. Brazilian stocks are extremely cheap by any measure. The market has been beaten down by political instability, currency weakness, and commodity price volatility. Investor sentiment is deeply negative. But Brazil has enormous natural resources that the world needs. Agricultural commodities, iron ore, oil. As the global economy continues to develop, demand for these resources will grow. Brazil is positioned to benefit. The key risk in Brazil is political. The country swings between left-wing and right-wing governments with very different economic policies. Property rights are sometimes uncertain. Corruption is endemic. These are real risks that justify a valuation discount. But the current discount seems excessive. Brazilian stocks trade at single-digit price-to-earnings ratios. Even accounting for the political risk, this seems too cheap. If Brazil can achieve even modest political stability, the re-rating potential is enormous. Mexico is interesting because of its proximity to the United States. As companies look to nearshore production to reduce dependence on China, Mexico is a natural beneficiary. Manufacturing is moving to Mexico. Supply chains are being reconfigured. Investment is flowing in. Mexican stocks are cheap despite these positive trends. The market worries about security issues, about political interference in the economy, about the relationship with the United States. These concerns are legitimate but probably overblown. Mexico's integration with the American economy provides stability that other emerging markets lack. Let me also address how to actually implement an international allocation. For most investors, individual stock picking in foreign markets is not realistic. The information disadvantage is too great. The research requirements are too demanding. Funds are the better approach. Index funds provide broad exposure at low cost. You can buy a total international stock fund that gives you exposure to thousands of companies across dozens of countries for a few basis points in annual fees. This is the simplest approach and appropriate for most investors. Active funds can add value in less efficient markets. International and emerging markets are generally less efficient than the American market. There is more opportunity for skilled managers to find mispriced securities. A good active manager with expertise in a specific region can be worth the higher fees. Exchange-traded funds offer flexibility and low costs. You can build a customized international allocation by combining country-specific or region-specific ETFs. This allows you to overweight the regions you find most attractive while maintaining broad diversification. The specific vehicle matters less than the allocation itself. The important thing is to have meaningful international exposure. Whether you achieve that through index funds, active funds, or ETFs is a secondary consideration. I want to return to the psychological dimension of this trade because I think it is where most investors will fail. The last 15 years have conditioned American investors to believe that American stocks always win. Every time international stocks have seemed attractive, they have disappointed. Every time the valuation gap has seemed extreme, it has gotten more extreme. This conditioning creates powerful psychological barriers to international investing. When your neighbor is bragging about his American tech stocks and you own boring international value stocks, you feel foolish. When American stocks keep going up and your international holdings lag, you question your analysis. When everyone agrees that America is the best place to invest, disagreeing feels uncomfortable. These psychological pressures will cause most investors to abandon international stocks before the trade works. They will sell at exactly the wrong time, right before the regime change that finally rewards international investors. They will lock in years of underperformance and miss the outperformance that compensates for it. The only way to avoid this fate is to have genuine conviction in your analysis, not hope, not wishful thinking. Conviction based on understanding the historical patterns, the mathematical relationships, the valuation differentials. Conviction that can withstand years of being wrong in the short term. I have that conviction. I have seen these patterns play out before. I have seen consensus views that seemed unassailable turn out to be exactly wrong. I have seen patient, contrarian investors rewarded while impatient, consensus-following investors were destroyed. The international trade requires patience. It requires conviction. It requires willingness to look different from everyone else. These are the same qualities that every successful contrarian investment requires. They are rare qualities. Most investors do not have them, but the investors who do will be rewarded when the regime finally shifts. I am positioning for that shift. I am building international exposure while prices are cheap. I am willing to wait years for the payoff. I am confident that the math will eventually work in my favor. The American stock market has been an incredible wealth-building machine for 15 years, but past performance does not guarantee future results. Current valuations do predict future results, at least over long time horizons, and current valuations strongly favor international stocks over American stocks. Follow the math. Ignore the narrative. Build international exposure while you can, and have the patience to wait for the inevitable regime change. That is why I prefer international stocks over American stocks in 2026. Not forever, just for now, while the opportunity exists. The opportunity will not last forever. Eventually, the valuation gap will close. Eventually, international stocks will have their moment. Eventually, the contrarians will be vindicated. I intend to be positioned when that happens. The question is whether you will be too.